So someone should help us with the, all right. Okay. Before we even start the reading, you have to know what you are going to be preparing. Okay. The question is asking you to prepare consolidated statement of profit or loss for the year and also the statement of financial position. So that will be prepared in the name of the Shisha PLC. So you just go and put your the statement there. So you come to the okay the name of okay consolidated statement of profit or loss for the year ended. Okay, let's look at the dates there. 31 March. So for the year ended 31 March 2023. So you bring your items there. The first one will be the revenue. Okay, the revenue the parent own will automatically come. So you can go and bring the parent revenue there. What is the revenue for the parents? 15,000. So the revenue for the parent is 15,000. For the subsidiary, it can be a full year or it can be just some months. So don't bring that one yet. So we have the 15,000. Then we have the cost of sales. The cost of sales. What is the cost of sales for the parent? 10,500. So we have 10,500. Then you have your gross profit here. For the gross profit, don't do anything because if you do, your workings will, your gross profit will come. So you come to the operating expenses. So these operating expenses, we are just going to be adding everything to the operating expenses of 1,500. So we have operating expenses of 1,500. Then we have our finance. Okay. So we have our finance interest received or paid. So what will happen? We have the finance interest received or paid. So we are putting the interest. So we have the finance. So let's use a finance income first. Who is having a finance income in the question there? Who is having an income?
The parents, that's it, sir.
Okay. The parent is having a finance income of 18.75. So you count finance cost here. That will be for the subsidiary of 50. Or if you like, you can put the two together as one. Okay. So what will happen is that we now have profit before tax. I don't think we have assets in the question. So we have profits before tax. Profit before tax. Then you count your tax expenses. You count your tax expense. Okay. Your income tax is 750, 750, and 150. So you have your 750 there. Okay. You have your 750 there, and let's just there's a fair we don't know what will happen. Okay. So we just put a subsidiaries on there. And after that, let's go to statement of financial position. Okay. So let's start the social group statement of social group consolidated statement of financial position at as at 31 March 2023. So we now come to our figures here. We have our assets, then we have our non-current assets. Let's go and pick the first non-current asset. What is the first non-current asset there?
PPE.
Property, plant, and equipment. For statement of financial position, whether the acquisition is done on the last day, the parent will still consolidate the subsidiary. So this one we don't pro rata. It will be for the
830.
430 plus what? 2,000. Okay. The investment will be for the amount that we are paying for the shares. But what we'll do is that at the end of every day or at the end of the day, you have to reconcile to see whether the investment is actually the entire investment in the what? In the subsidiary. So you can still bring the investment of 2820. If that is the purchase consideration, then we just cancel it off. Okay. Then there might be a goodwill in the question. So you write your goodwill, then you come here and have your current assets. For the current assets, we are giving just one figure for all of them. So the current asset is 3750 and 2000. 3750 plus 2000. Okay, let's go to equity, and liabilities. Okay, so we have the share capital. The share capital will be that of the parent. So let's go to the equity items will always be for the parent. So the share capital is 2,500. 2,500. Then we have the retained earnings that we do workings for it. So we retain earnings workings will be done for that. So we go and do workings for that. Then we come to the non-controlling interest, which will be the NCI for that. Then we now go to the next one, which will be the non-current liabilities. Non-current liabilities, that will be 10% loan notes. So non-current liabilities. Non-current liabilities. 10% loan notes. And that is for only the subsidiary. So we can move on to current liabilities. Current liabilities of current liabilities of 2,500 against 900. All right. So with your issues here, so maybe let's start with the workings. Okay. So the workings, the first one will be the group structure, which you have to put there. So you have your group structure as the first one. So you have to put the group structure there, the acquisition date, the reporting date, and the post-acquisition period. Okay, we all know how to do that. Let's just go to our second workings, which will be the net assets of the subsidiary. What is the name of the subsidiary? Okay, please, you only do the net asset workings when you are going to do statement of financial position. So the subsidiary is this. So you can underline this. You have at acquisition, then you have at reporting. Okay, this one you don't have to go and do anything to get this figure. You bring the share capital of the subsidiary. What is the share capital of the subsidiary? What is the share capital of the subsidiary?
500.
So that would be
500.
500 for acquisition and reporting. The next item that will come here is return what? Earnings. So the return earnings now, you have to go and determine the acquisition date. So let's look for the acquisition date. Okay, you can just count through to see the acquisition date. Okay, the acquisition date is what?
1st July 2022.
Okay, so from 1st July to 31 March, how many months is that?
Much.
9 months.
That will
9
be
months.
9. Okay.
Mm.
So after getting the 9, then we can now go and work on. So you just forget about this net asset. Then you can go and work on your profit or loss items now. So this will be plus 9/12 multiplied by what? So we go and look for the revenue figure. That will be 6,000, isn't it? So it means that we are going to have a share of only 9 months profit. So that will be 6,000. Let's come here. We have 9/12 multiplied by cost of sales. So that will be 5,000.
5,000.
We come to the 5,000. Okay. So we have the operating expenses will be 9/12 multiplied by. Let's go to their operating expenses. Their operating expenses is 50.
50.
Okay.
50.
The 50 here. So they don't have anything over here, but the finance cost is for them. But the finance cost is relating to something at the top here. So that one don't adjust yet because the parent has purchased a loan note in them. So maybe the figure over there will be, that is for the loan note. So we will read the top there, we do the adjustments before we now what adjust the rest. Okay. So let's come to this one over here. Okay. So let's come to the tax expense will be 9/12 multiplied by 9/12 multiplied by 150.
150.
Okay. All right. So doing this now, then we can now move on to get our retained earnings. Let's come here. Let's come. What is the retained earnings for the subsidiary? What is the reporting retained earnings? The retained earnings at the end of the year. Is what?
2001.
Okay, 2,100. Okay. This 2,100. Okay. Can we say that this 2,100 is the retained earnings at the beginning plus the profit for the year is equal to the 2,100, isn't it? Can we say that?
Sure, that's it.
Okay. So the question is that this profit over here is for 12 months, isn't it?
Yeah.
Okay. They have done what? 3 months before we acquire them. Okay. They have done 3 months before we acquire them. So included in this particular profit is a post-acquisition profit of 9 months on the 750. So what you do is that find a 9 month profit over here and take it from the total retained earnings. That will give you the retained earnings at acquisition. It will be the opening balance plus the 3 month profit. But the profit for the year is 750. This profit is 3 months for pre-acquisition and 9 months for what? Post-acquisition. So post-acquisition profit should not be the part of the retained earnings at acquisition. So we take 7 months profit from this particular 2,100 and we are going to be getting the retained earnings at acquisition. Or you find the retained earnings at acquisition yourself, then you will now find 3 months profit over here and add it to it. You'll be getting the same figure. Okay, so let's do 2,100 minus 9/12 multiplied by 750. What are we getting? What are you?
157.5.
Okay, 1537.5.
0.5.
But the return earnings at reporting will be what? At reporting will be which figure? Okay, that will be 2,100. Okay, so this one, we have done this one now. So let's just read the footnotes now. Okay, so let's read for the top there. Let's read from the top there.
On 1st July 2022, Shisha PLC acquired 80% of the ordinary shares of Wale PLC at a cost of 2,570.
Okay,
On the same date, it also
let,
acquired
let's
50% of Wale PLC's.
let's go to the purchase. Let's go to calculation of goodwill from that side. So we have calculation of goodwill. We know the purchase consideration now. So we have our purchase consideration. Our purchase consideration to be 2,570. Is that correct?
Yes, sir.
Okay. So they say that they have paid cash for 27, that one. So it means that that particular amount has been recognized. So we go to our investment, then you take your 2,570 from this, because the question did not say that it has not been recognized or it has been recognized. So since they say that they acquired this at a cost of 2,570,000 or 70,000, it means that we have paid what? Cash for that, and that has been reported in the financial statement. So we take it from the investment. We will take it from the investment because the investment will cancel the equity component of the subsidiary. The resulting figure will be what we call the goodwill. Okay. Yes, now you can continue now.
On the same date, it also acquired 50% of Wale's PLC's 10% loan notes at par. The summarized draft financial statement of both companies
Okay.
as stated below.
Okay, let's take that one. On the same date, it also acquired 50% of Wale's what 10% loan note at par. Okay, at the time that the ordinary shares were acquired, the parent is now the what the majority owner or is now the ultimate owner of the subsidiary. Is that correct? At the time that the parent acquired 80%, at the time that Shisha acquired 80% of Wale, Shisha on that date is now the ultimate owner of what? Of Wale PLC. Is that true?
Yes,
If you are the owner, it means that the liability, the asset, and everything for that company is yours, isn't it?
yes, sir.
Yes.
Okay. So if you are now, the liabilities will now be owned. You will now be the one to assume the 10% loan note. If you are not buying back of the 10% loan note, what are you doing? Are you going to be having asset or you are paying back part of your liability?
You
You're
should be
paying your
paying back.
liability.
You should be paying
Paying
back
your
your
liability.
liability.
You are paying back your liability. Okay. You are paying back your liability. So what we are going to do is that, but in their separate financial statements, the parent will be recognizing this as a financial asset, which will be in the investment. And the subsidiary will still be keeping the what? The half of that. So let's find the half of what they are talking about over here. So the 10% loan note for the subsidiary is how much?
500.
Okay. So if you find half, what will be the half?
250.
Okay. The 250. Add the 250 to the consideration that the parent has paid and see whether it will give you the figure that they have there as the 2820.
Yes, it's 2820.
Okay. So it means that the parent is having this as what? As a financial asset in the investment. No. After acquiring the subsidiary, you are now the ultimate owner. So you are going to assume the liabilities and everything. So if you are buying back part of the liability, it means that you are paying the what? The loan note holders. So you cannot have assets and the liability will be the subsidiary will still be having liability again. So we cancel this. So the investment over there will be canceled and the 500 loan note will now be reduced to what 250 because the parent has paid what 250 out of it. So you go and cancel this transaction and we come back to do if there's any loan note received or loan note paid. So we cancel that. You come to the 10% loan note. You also cancel this because the parent is saying that he or she is having an investment in the subsidiary. Subsidiary is also saying that he or she is owing the parent. There cannot be any owings like this within the group. You can't be investing in the loan note of your own company. You are paying the loan note holders back. So we are going to remove that. But what will happen is let's see whether there will be let's see whether the question is saying that they have receive any this one. But since this particular transaction has been recognized, it means that they are going to receive a loan note interest, and the subsidiary will also be paying what interest to the parent. Okay, so let's come here. The loan note that we are buying is 250. What is the interest on it?
10%.
25.
No, it will be for
20,
2.5.
25.
It will be for 9 months. It's not a full year. It's 1st July. Okay. So the interest will be what? Will be
18.75.
0.1 multiplied by 250 multiplied by 9/12 is what?
18.75.
So you can see that the loan note received by the parent over here is what? Is the interest from what? From the subsidiary, which should not be possible. So we reverse the what? The interest received also and the interest paid also. So the 18.5 will not be received from the parent because you can't be having investment in your own loan notes. So you are paying the loan note back. So we count to the finance income of the parent over here. This will go. All right, let's come to the finance cost. What is happening? The finance cost, the subsidiary is paying 18.75 to the parent. Is that correct? The subsidiary is paying what? A finance
Yes.
of 18.75. This one
Yes.
is for what?
It's for 9 months.
Is for the 9 months. Okay.
Mm.
So the question now is our total finance cost for the subsidiary is 50. Okay. This 50 is including the interest for what? For the 9 months, 18.75. Assuming this particular finance cost hasn't been incurred on the loan note to the parents, what would have been the finance cost for the full year? What would have been the finance cost for the full year?
Okay, so you subtract the 18.75 from the 50.
Okay. Okay.
Then you get 31.25.
31.25.
25.
Okay. 31.25. Okay. That 31.25 now, what we want to do is this. Okay. Let's come to the loan note again. Okay. You can see that the total finance cost over here is 50. The total finance cost over here is 50. So that is what you are going to do. Okay. The total finance cost is 50. Okay. You are going to be, from the time that the parent is going to be buying this particular loan note, you are going to be having 250 from that date. You are going to be having 250 from that date. Okay. So it means that the loan note over here will be multiplied by 0.1. You have so many ways of doing this. Okay. So let's have the let me just do the first one so that I can also show you. So this will be 18.75. Then this 18.75, we now find what? 9 months of it, isn't it? Because the full year will be 50 minus 18.75. Then you multiply by 9 months. What are we getting? I will also show you another way of getting that. Okay. That will give you what are you getting?
$23.4.
No,
Four.
that should not be 23. So maybe the first one. Okay.
It should be 35.94.
Okay. No, it should be. So let me show you the another way of doing this. That will not work. Okay. Before the parents acquire them, they have done 3 months already, isn't it? So before the parents acquire them, they will pay interest of 0.1 multiplied by 500 times what? 3/12. Is that correct?
Yeah.
Okay. What will be the amount?
12.5.
12.5.
Okay. So it means that the interest relating to what? The pre-acquisition period is what?
12.5.
12.
12.
Okay. So what will be the interest for the post-acquisition period? It will be 0.1 multiplied by the 500
500
multiplied by
times
9 by 12.
9 over.
So
12.
what are you getting?
37.5.
Okay. So the post-acquisition interest should be 37.5, isn't it? But included in this
Yes.
one is what? 18.75 for the parents. So the post-acquisition interest should be 18.75. 30.75, not the 23 there. So I don't know why you are getting that particular figure, 32.25. So the post-acquisition interest is 18.75. Okay, it's 18.75. Okay, let me also show you another way. Okay, try this one and see. Try this one and see. Okay, fine. Okay, so this is the total finance cost is 50. So let's find the 9 months and see. If you find 9 months of it, what are you getting?
37.5.
7.05. That's
37.5.
7.5.
Okay. So that 37.5 is the post-acquisition one. Included in that is the parent 18.75. So what are you getting? Are you getting the same 18.75?
Yes, 18.75.
Okay. Okay. So the finance cost would be the 18.75. So the 9 months will be 37 points. And that one will be this one. So the finance cost over here will be dashed for the parents. But let's come to the post-acquisition or the net assets here. Okay. What would be the effect of the finance? So let me go to group return earnings and the rest there. So when it comes to non-controlling interest, the non-controlling interest. So the non-controlling interest, let me go to group return earnings. Okay. Group return earnings. So let's go to the parent figure. The parent figure. Okay. The parent figure is, what is the parent group return earnings? What is the parent group return earnings? 6,400. Okay. 6,400. Okay. So the 6,400, what we do now is that the finance interest has been added to their profit. So we come here and take away the finance interest because the 6,400 over here has been calculated based on their profit. So the profit for the year of the 2268.75 has been added to the opening balance and they have gotten the 6,400. So it means that the finance interest of the 18.75 is part of that. Okay, let's come to the subsidiary net asset also. The finance income or the finance cost. Okay, the finance cost of the 18.75 has been taken away from their profit before getting their profit for the year. So since you are reversing and add back to their profit, it should not be taken away from their profit. But looking at the figure that has been taken away from their profit, they have gotten 750 for that year. So the 18.75 have been taken away from their post-acquisition profit. So you come and add them back. So you cancel or you reverse the finance cost for the post-acquisition period, and you also reverse the finance income received by the parents. Okay, that is the one that will go for profits or loss and statement of financial position. Let's go and see what we are going to be having again. So let's start with the footnote 1 now. We are done with that.
The fair value of Wale PLC assets were equal to their book value, with the exception of 8 plants, which had a fair value of 800,000 in excess of its book value at the date of acquisition. The remaining life of all Wale PLC's plant of its acquisition was 4 years, and this period has not changed as a result of the acquisition. Depreciation of plant is on a straight line basis and charged to cost of sales, while a PLC has not adjusted the value of its plants as a result of the fair valuation of the assets.
Okay, so it means that they are saying that the fair value of the a plant is now 800 more than the carrying value, isn't it? Okay, at the date of acquisition. So at the date of acquisition, it means that we have to, what are we going to do to our assets, our PPE?
We'll add the value to it.
Okay, the values that you have in your statement of financial position are based on book values. So this PP over here, the 2000 over here is based on the carrying value, but they are saying that the time that we acquired them, the value of a plant has increased by 800, but we have not taken that into consideration. So what will happen is that our net asset was calculated based on what? Based on book values. So at the date of acquisition, our net asset must increase by the plants. Okay, so we have plants to be 800 at acquisition, the same 800 at reporting. What will happen? We come to
Depreciation
of depreciation there. Okay, they are saying that the asset has what? Okay, so the asset has a useful. So let me come to depreciation here. Okay, so let's come to depreciation of the plants. Depreciation of the plants. So the depreciation will be on what we calculated the depreciation, or we depreciated the asset based on a book value. But now they are saying that the value has increased by 800. So it means that if we should be aware of this particular adjustment, the depreciation would have been calculated on 800 plus the carrying value at the date of acquisition. So since we calculate the depreciation on only the carrying value, it means that the depreciation on the fair value adjustment has not been calculated. So let's ask ourselves, this asset was it was on 1st July, and we have done 9 months already. So it means that the value cannot be the same at the reporting date. So you do multiply by 9/12. You find the yearly depreciation, multiply by 9/12. What are you going to be having?
150.
150. Okay. So this 150, it should be taken away from our profit. So we come to depreciation over here. It will go to the net asset dash. Then we have 150 here. You also go to your cost of sales and add the 150 to it. Okay. Then you also come to your assets now. You subtract 150 because it will no longer be 800. It will be the 800 minus the portion that you have used. Okay. That is sometimes the question can tell you that there will be a deferred tax issue on the fair value adjustment. They will give you the tax rate. So if there's a revaluation, the carrying value of the asset will automatically be higher than the tax base of the asset by the revalued amounts. Because the tax authority they have no idea about what we call revaluation. They carry the asset at the cost less the capital allowance. So as soon as there's a revaluation, the value of the asset will automatically be higher than the tax base of the asset in the books of the tax authority by the fair value adjustment. So you find a deferred tax at the date of acquisition, then you still find deferred tax at the date. So what you do is that, assuming the tax rate is what? The tax rate is 25%. We don't have that over here. But if the tax rate is 25%, we find a deferred tax of 0.25. The assumption is that assuming you are paying tax on this particular gain now, what would have been the tax? So what would have been the tax for us? Would that be 200?
Yes, 200.
Okay. So there will be a deferred tax of 200. There will be a deferred tax liability of 200. So the deferred 200 will be taken away from what? From our net asset at acquisition, because the revaluation is happening at the date of acquisition. So the deferred tax should be taken at the date of what? Acquisition. By the date of reporting, you have to what? Revise your what? Your deferred tax liability again. You see that at the date of the reporting, the carrying value of the asset will be 800 minus 150. Is that correct?
Yes,
Yes.
please.
Okay.
Yes, please.
So it means that the value on the asset now will be what? 650. So the deferred tax cannot be 200 again. So you now have to find a deferred tax on the what? On the closing balance again. So at the end of the reporting period, your carrying value will be higher than the tax base by only 650. So what will be the deferred tax on that 650? That will be
162.5.
okay, 162.5. You can see your deferred tax provision has reduced, isn't it?
It has.
It has reduced from 200 to what? Okay. So what will be the movement in deferred tax as a what? As a gain to your tax expense? It will be 37.5, isn't it? All right. This 37.5, you can also calculate it in a different way. Okay, you see that you have depreciated the asset for 150. The tax authority will give you a capital allowance on this. So the tax benefit will be 0.25 on this figure. That will give you 37.5. Okay. So by this one, they haven't given you issue of deferred tax. So you just have to ignore and what? And move on. Okay. But just in case, but that deferred tax issue for financial reporting, I don't think so. But for corporate reporting, it can be possible. But please have it in mind, anything is possible. Okay. We are done with the footnote 1 now. Let's go to the B.
In the post-acquisition period, Shisha PLC sold to Wale PLC at a total value of 3 million Ghana cedis. These goods has cost Shisha PLC 2.250 million cedis. During the year, Wale PLC has sold 2.5 million cedis out of the 3 million cedis goods from Shisha PLC for 3,750,000 Ghana cedis.
Okay. So what are they talking about over here? They are talking about intergroup trading. Okay. What do? We have to go and remove the what? The sales from cost of sales and what? The revenue, isn't it? So we go there, we remove our sales of 3,000. This will also be 3,000. Okay. So what will happen is that we are removing from the cost of sales more than that. So we have to do provision for unrealized profit. So let's calculate our provision for unrealized profit. This one, you have not been given percentage. So you have to look for the way of doing this. The goods were sold for what? The goods were sold for how much?
375.
No,
3 million.
no. We are only concerned about the profit that the parent will not be realizing from the sale. These people, they have sold it for 375 because maybe they incurred additional costs. So they want to recover their cost.
Okay.
That is not our business. We just want to know what portion of the profit that is not realized from the seller, which is the parents. Okay. The parents sold the goods for 3 million. Okay. But these goods has cost the parent how much?
2250.
So what is the profit on it?
250.
No, it's 750.
Okay.
It's 750, isn't it?
750.
Okay.
Yeah.
So it means that if we sold all these goods, the profit will be 750. So 750 is for the 3 million goods. Okay. But what is the value of the goods sold?
25.
So it means that we have sold only 25. What is the portion that we are not sold?
500.
Okay. So we just find the unrealized profit on the 500. It will be 500 over the total sales multiplied by the 750. That is the unrealized profit because the 750 is on the 3,000 goods. So what will be the profit on the 500? So that is how you do it. So it will be the sales value of the unsold goods divided by the sales value of the total goods multiplied by the 750. What are you getting?
125.
It's 124.99, so 125.
125.
Okay, let me see. 750 divided by 3,000 times 100. Well, are you sure is that figure? I'm getting 187.5. Can you do that again?
You get exactly 125.
750.
It's 125.
125. Okay.
Yes.
Let me.
Yes, 125.
It's 125. Okay. Let me
Yes,
check.
please.
Let's find the margin. Okay. Would the margin be 750 over 3,000?
Yes.
Okay. So what are you getting for the margin? 25%.
25.
0.25.
So multiply by the 500.
It's
The
the same.
5.
It's
You're
125.
getting
right?
125.
It's
Yes.
125.
First, I got 187. So I don't know why. So this will give you the 125. Okay. How do we treat the 125?
That's the unrealized profit.
Unrealized profit.
So yes, I know it's an unrealized profit, but how do I treat it?
You deduct it from
Subtract it.
Less from inventory.
Okay, so let's go to the inventory first. So current asset now will be 125. Okay. We are preparing statement of profit or loss too. So that will be added to cost of sales, isn't it?
Yeah.
If we are not preparing statement of profit or loss, who is selling?
the parent.
From the parent.
So that will be taken for provision for unrealized profits from the parent. That will be 125. Are we okay? All right. So that is that for that side also. So this one, since you are preparing the two, the adjustment will be for all the two. So the cost of sales and the retained earnings, and then what? The inventory for the year. Let's count to them. The number C, the footnote C.
The current accounts of the two companies were reconciled at the year end with Wale PLC owing Shisha PLC 187,500 Ghana cedis.
Okay. What is the meaning of that? What is the meaning of that?
Receivables.
Is it that the current account of the two companies were reconciled at the year end with Wale PLC owing with Shisha PLC 187,500? If we have reconciled our accounts, if the two of us we are owing ourselves and we have reconciled our accounts, if we are not owing anybody, if you are owing me the same amount and I'm also owing the same amount, there should not be any owings from anybody again. It will just be zero, isn't it? Okay.
Yeah.
Yes.
But we have reconciled our accounts and we have realized that you are owing me what? maybe 500, it means that you still have to pay 500 to me, isn't it?
Yeah.
Yes.
Okay. So we are still going to be having Wale PLC. Okay. This the current account of the current account of this one. Let me see the 500 minus 125. Okay. So the current account. Okay, let me take that again. The current account of the two companies were reconciled at the year end with Wale PLC, Owen Shisha PLC, 187,500. Okay, it means that we are
Yeah. It's
this we are the current account of the two companies were reconciled at the year end with Wale PLC, Owen Shisha PLC, 187,500. The meaning is that Shisha PLC is still having receivables from what?
From Wale.
From what? From Wale, isn't it?
Okay.
Okay. So he's still having receivables from Wale. So what have to happen? We don't have to have that particular issue in the books again. So you have two ways of doing this. Maybe there was a transaction. There was a transaction where Wale is here to recognize that transaction, or maybe Wale has sent what a cash or a check to Shisha, but Shisha is here to receive that amount. So what you do is that this particular balance, you might assume that is goods in transit or it's a cash in transit, because the only thing that will cause the two balances or the two current accounts should be different, should be a goods that has been dispatched from the parent to the subsidiary, but the subsidiary is here to receive those goods, or it's a cash that the subsidiary has paid to the parent, but the parent is here to receive that cash. So what you do is, the best way is that there was no sales between these two people now. So we just rely on that current account as as cash in transit. So we have 187.5 minus 187.5. Then we now do what? What do we do? If it is a cash in transit, what do we do? The parent will still receive the cash, isn't it?
Yes.
Okay,
Yeah.
so it can be minus and plus. Even if you are saying that, okay, it is a goods in transit or it's a transaction in transit, which the subsidiary is here to recognize, you can still go ahead to payables or their current liabilities and add this figure and still subtract it again. But let's assume that it's cash in transit. So this will be 187. Then the parent will now receive the 187 again. So at the end of the day, it is going to be having a zero effect. So even if you omit it, nobody's going to do anything, because it's only that ticks that you will not get, but the current asset balance will still be the same. But if they say that the two current accounts has been reconciled and they agree at a figure of this one, so it means that you go and take that figure from payables and you take that figure from what? From receivables. But they say the two accounts has been reconciled, but still Wale is owing what? Shisha a certain amount of money. It means that Shisha is having a receivables higher than what? The payables by that particular amount. So you either assume to be cash in transit or goods in transit. Cash in transit will be better, because if it should be goods in transit, what will happen is that we still have to find unrealized profit on that particular goods again. We still have to find unrealized profit. But since they are not specific, you are free to assume that it's cash in transit, because it's not only the goods that has been sold to the subsidiary that can cause that difference. The subsidiary can also send cash that the parent is here to receive. So if you assume it's goods in transit, you have to calculate. Then it means that the goods has not been received, so the goods has not been sold. So that particular unrealized profit must be adjusted. But if you want to avoid that, then just assume that it is what? It is cash in transit. Then you just add and subtract. Please, any question on that? They should have told you that, okay, the difference over there is a goods sold to is goods sold to what? To the subsidiary again, or goods are being dispatched to the subsidiary, which they are here to account for. So in that case, it means that 25% of these goods has not been sold. So you find unrealized profit because the margin over here is 25%. So you find that. But since they were silent about that, please, let's do the easiest one and move on. Okay, it is cash in transit. Let's move on. Okay, D.
Goodwill also.
The
Auntie,
good
Auntie
the
Victoria,
good
your hand is
was
up.
you.
I saw the hand up. Victoria.
Yes, please. Please, concerning the C part,
Okay.
the 187.5. Even if it's going to be cash in transit or goods in transit, I'm thinking it should affect both the current assets and then the liabilities. Or
You are thinking, you are still asking me question.
yeah, I stand to be corrected as well.
Oh, okay.
Because as they are saying, Wale PLC is owning Shisha. So meaning in Wale's account, you'll be having the creditors there.
No,
And
no, no.
then in Shisha's
They
will be
have
the
paid.
debtors.
Why is it cash in transit? They have paid, but the parent is here to what? To receive the cash. So they have recognized the payment in their book. So they reduce their cash and they reduce their payables. But just that the parent is here to do the what? The entry in their books. So they have paid the cash. They have sent a check to the parent entity, but the parent is here to what? To cash out the money. So the time that we have written the check, we have entered the transaction, we reduce our payables by the amount that we are paying to the parent, and we also reduce our cash account or bank account also by the same thing. So it means that the transaction has already been done in the books of Wale. It is left with the parents. So that's why we focus on the parent side. So if it is a cash in transit,
Okay.
the transaction has been done in their books already.
Okay, thank you.
All right. Yeah. Okay, so now can you take the D for us?
The goodwill was reviewed for impairment at the end of the reporting period and has suffered an impairment loss of 75,000, which is to be treated as an operating expense.
Okay. So let's go to the operating expense first. So operating expense, we come and add 75 because the goodwill will entirely be post-acquisition. The goodwill will come at the date of acquisition. But what you do is that scan through and see whether our net assets, scan through and see whether our net assets, they have even given you these figures. So they are retained earnings at the beginning of the year. Okay. Maybe it's the same figure that they are giving to you. We have done that already. So let's find their retained earnings at the beginning of the year and see whether it's the same thing. 2,100 minus 750. Okay, it's the same figure that they are giving to you. So forget about that. Okay. So the NCI, how are we measuring the NCI? Is it proportionate or is it's at fair value?
Value.
The NCI is fair value, isn't it? Okay. So let's get the NCI value there. We come to the goodwill apportionment, but let's go to our NCI first. So let's get our NCI. So fair value at acquisition, fair value at acquisition. I'm sure it's 625, isn't it? Okay.
Yeah.
So if it is 625, it means that the impairment of the goodwill will be shared among the parents and then the NCI. So share of impairment. Okay. NCI, what is the percentage for NCI? That can be obtained at the top there. Okay. The
20, is
percentage,
it 20%?
okay, 20%. Okay, that will be 20%. So we have 20% multiplied by 75. What are we having? Then we go to the share of impairment. Share of impairment 0.8 multiplied by 75. What are we getting for?
15.
So this will be 15
Hmm.
and this will be 60.
60.
60.
Okay. So let's go to, so we are done with the impairment adjustment already. We have added it to the operating expenses. But after we have gotten the goodwill, we have to take the impairment loss from it to get our goodwill at acquisition. Okay. The Shisha, yeah, Senior, can you take that one?
Shisha and Wale PLC's retained earnings as at 1st April 2022 were 4,131,250 and 1,350,000 respectively.
Okay.
No dividends were paid or declared by either entity during the year.
Okay. So they have given us the
Someone
return.
please take the last two and let me say my prayers.
Okay. 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 Thank you.
Thank you, too.
They have given us the retained earnings of what Wale at the reporting date, which is 1350. Okay. Let's come here. Their retained earnings over here. The closing retained earnings is what? Is 2,100. But included in this one is a profit for the year of 750. So the retained earnings at the beginning, just subtract the 750 from the total there. So we have done that already. Okay. We have done that already. I don't know whether there. So that will still give you the 1350. Okay. So what we have done is correct. But if the retained earnings at we have done that already. So let's forget about that and we move on. Okay, let's forget about that and move on. It is the policy to value the non-controlling interest, and this revenue profit should be deemed to accrue evenly. So you just have to do your correct what? You apportion the revenue and the cost items using the 10% and all those things. Let's come to our net asset at acquisition. What will be the net asset at acquisition? I'm getting 2837.5.
That is confirmed.
Okay, let's come to 500 plus 2,100 plus 18.75 plus 800 minus 150. I'm getting 3268.75.
That is confirmed too.
Okay, what is the post-acquisition profit? 3268.75 minus 2837.7.5. I'm having 431.25.
All right, that's good.
Okay, so let's come to the goodwill calculation. What we do is that we bring our NCI here. So let's total Then we bring our net asset here. The net asset at acquisition is 2837.5. Okay. Please, what is the total for our 2570 plus 625? I'm having 3195. So what will be the goodwill at acquisition? Okay, I'm having 357.5. Then we now come to impairment. This has impaired by 75. So let's take the 75 from it. Minus 75. 282.5. So our goodwill at reporting is 28.5. So workings 3. 282.5. This will now be dashed. Okay. Let's go to the share of the profit for them one by one. So we have the share of profit. We have 0.2 multiplied by the 431.25. What is the share of the profit for the NCI? I'm having 86.25 share of post-acquisition profits, 0.8 multiplied by 437.25. For a 431, not 7. 431. 431.25. I'm getting 345. 345 as a share. Okay. So let's now go to our statement of profit or loss and put these figures together. So what will be the revenue? I'm getting 16,500.
Yeah, that's fine.
Okay. So 0.75 multiplied by 5,000 plus 10,500 plus 150 plus 125 minus 3,000. I'm getting 11,525.
Yeah, 11,525.
Okay. So the operating expenses, let's come to the operating expenses now. 0.75 multiplied by 50 plus 75 plus 1,500. I'm getting 1,612.5. One, 612.5. Is that
Okay.
confirmed?
Yeah.
Okay. So we can now find our plus 18.75 minus 4975. Profit before tax is 3343.75. Okay. So we have our tax to be 0.75 multiplied by 150 plus 750. We are having 862.5 minus 33 243.75. So our profit is 2481.25. There is no other comprehensive income item. So 2481.25. Okay. What do we do? After getting this profit, what are we going to do? We have to find the parent portion of that profit and the NCL portion of that profit. So profit attributable to profit for the year attributable to the parent holding. Okay. If you are doing the two, okay, I will show you the easiest way of getting the NCL. Okay. Let's go to the NCL share of the profit here. What is the NCL share of the profit? What is the NCL share of the post-acquisition profit?
20.
No, the figure itself, the figure itself that we have here for the NCL.
86.25.
Okay, that is before what?
20.2.
That is before impairment, isn't it?
Yeah.
Okay, take impairment from it. If you take the impairment, what are we having? I'm having 71.25.
Yes, please.
Okay, so the
Yeah.
NCS share is 71.25, but we are going to calculate that. The NCS share over here will be after impairment because profit or loss, it will be after the impairment. But how do we do this? First of all, find your 9 months profits. So we find our 9 months profits, which will be on the total profit reported by the subsidiary. So 9 months profit there. The 9 months profit is how much? Is 7 what? 50, isn't it? Okay. So 750 of the 9 months of the 750, what are we having? Okay. So this 9 months, what you do now is that this 9 months profit now must be adjusted with what the post-acquisition items. The first one is we are going to reverse our finance interest that we pay to the parent. It should not be paid, so we reverse it. This is post-acquisition. Then we now have our what? Depreciation on this item. So this, let me just say, these are the items that you'll be bringing to your post acquisition what adjustment. So depreciation should have been subtracted from the profit, but we didn't subtract. So you bring the depreciation also there. Then the impairment will be coming here. So at the end of the day, you multiply this by 0.2. Okay. So we have 9/12 multiplied by 750. Okay, plus 18.75 minus 150, then minus 75, 0.2. What are you having? What are you having for that one? Is it the same as the 71.25? Can someone confirm the 71.25 for us? Mine over 12 times 750 plus 18.75 minus 150 minus 75. The answer multiplied by 20%.
1.25.
Okay. All right. This one too. They say none of the entity has paid a dividend. So the parent retained earnings should be the same as 2410. Okay, let's check that. They say the parent has none of this company has paid a dividend. So nothing is going to be affecting their figures there. So the group retained earnings should be the same as, so let's total the NCI. 625 minus 15 plus 86.25. So 696.25. None of the entity has paid a dividend. So the parent figure should be, the parent profit for the year should be the 2410 plus the balance at the beginning. Let's go to the balance at the beginning there for them. So that should be the profit for the year to be 210 plus this one, 4131.25. It should be getting 6541.25. Let's check that and see. Okay. Okay, so 6541.25. So let's check that. 6,400 minus 18.75 minus 125 minus 60 plus 345 6541.25. Is that confirmed?
Yes, please.
Okay.
Yes.
So I was saying that since the only thing that can reduce the profit for the year of the parents is the dividend that they are going to be paying. But the question states that none of these company has paid a dividend for the year. Okay. Let's say no dividends were paid or declared by either entity during the year. So if that is the case, the retained earnings at the reporting of the parents will be their retained earnings at the beginning of this figure. Okay, it will be beginning of this figure plus their profit for the year, which is what? 2410. So you just put the two together. You don't have to go and be adding that one again. You'll be getting your 6541.25 because no dividend has been paid out of the profit. So it will be the profit plus the retained earnings that they have at the beginning, which will be the 61.25. But you don't have to be doing that. Just come to your normal calculation here. Dividend must be paid. So that might not be the same. So dividend must be paid out of the profit. So you have to calculate using your group retained earnings calculation. But if no dividend has been paid, then it's just a profit plus so let's count to workings 5 here. We have 6541.25. We have 2,500. The NCI will be workings 4. What are we having for the NCI? It's 696.25. 696.25. This one will be 250 here. Our liabilities will be 3,400 here. So let me just bring the 3,400 here. Let's go to our assets. What will be the PP figure? 482,4830 plus 2,000 plus 800 minus 150. 7480. Is that confirmed? Can someone confirm the 7480 for us?
I do.
Okay. So let's come to our current assets now. We have 3750 plus 2,000 minus 125. That will give us 5625. So the 2 give us plus 7762.5. Okay. You'll be having 13387.5. So that will give you your total assets. Please don't go there and be doing working capital issues. the IS1 says that we should calculate our total assets. So we should use our accounting equation. Total assets is equal to capital plus liabilities. So let's put this here, 2,500 plus 6541.25 amount 9041.25, okay, plus 696.25 plus 250, then plus 3,400. Hey. Okay. Thirty, 40 is 30 plus 2,000 plus 800 minus 150. Okay, 7480. So it's 541. No, okay. Let's total that again.
It's 250.
Okay. So 7480. That's 750. So plus 282.5, 7760. Let's count to 3750 plus 2000 minus 125, 5625. Okay, plus 7762.5, 13387. Okay, so let's count to the 2,500 plus 65, 6541.25 plus 696.25 plus 250, then plus 3,400. Okay, 13387.5.
Yes.
Okay, so that's all. Financial reporting people, I'm done with you people for consolidation. So tomorrow we are looking at advanced consolidation for corporate reporting. So we start with step acquisition. All right.
So it means we will not come tomorrow dawn.
You not count for all the dons now. You not count for you not count for Tuesday and Wednesday again.
Oh, okay.
But if you want to learn ahead, no problem. You can come.
No, let's master this one first.
It is well. Okay. So,
So, but the next thing I will indulge that it should be income tax.
yeah. The this thing. Monday we do the income tax.
Okay.
All right. Okay. Okay. So if there are no issues, let's go back to our normal schedule for the day, and we should.
Please, a minute. Please, can you go over the unrealized profit? I think I missed this step.
You said what?
The unrealized profits. Please, can you go over it again?
Which one? Is it the figure that I use or
Yeah, how you calculated it and all.
okay, let me pick that side for you again. Where is that? Okay, so let's come to that side. Okay, in the post-acquisition period, Shisha PLC sold to Wale PLC at a total value of 3 million. Okay, this goods has called what? Shisha PLC 2250. What is the profit element on the item? Anti-Eunice. The item was purchased for 2250, but it has been sold for 3 million. So what is the profit that they are making there?
750.
Okay. During the year, Wale PLC has sold what? 2,500 out of the what? The 3 million goods. So it means that they have how much, or what is the value of the goods left that they haven't sold?
500.
Okay. This particular one, this is what has been sold to a third party, or maybe they have incurred a cost on the item. They want to recover that. Our focus is not about how much they have sold this to a third party. We are only concerned with what portion of the profits that we are here to realize from the sales that we have made to them. Okay. We have sold to them 3 million goods. So if they are able to sell all the 3 million, we are going to get a profit of 750. Okay. So if 3,000 is equal to 750, they are here to sell what? 500. So if 3,000 is at 750, 500 will be what? Okay. So that will be, you just do your what? 500 multiplied by 750 divided by 3,000, which in another words means that if 3,000 is 750, so what portion will be for what? For the 500. So 500 out of the total. So 500 out of 3,000 multiplied by 750. You have your 125.
Sir,
Okay. Yes, Nia.
hello,
Thank
sir.
Yes, Nia.
I also like to know where you got the net asset at acquisition. That is 25.
The net asset at what? At acquisition, where
I'm the non-controlling interest.
no, the question, that one has been stated in the question there.
It's in the question. Okay.
The last part, the F. It is the group policy of this one to directors at this one at 625 at the date of acquisition.
Okay. All right.
All right.
Thank you, sir.
All right. So I'll see you guys. Take care of yourself. Living in Ghana is a blessing. All right.
Hello, sir. A minute. Hello, sir.
Yes, Senior.
Please, with